What is up, everybody? Welcome back to the channel. Today I'm going to answer a question that I've been getting from you guys a lot lately, and that is, how do I pay off my mortgage early using a home equity line of credit? Well, I have done the research, and in this video I will share with you a general overview of this strategy, this method that's called velocity banking. What are the pros and cons? What are the risks involved? And after learning about this strategy, whether or not it is something that I think that you may want to consider. But first, you guys, I want to thank you so much for tuning into the video. If you get any value or enjoyment out of this video at all, as always, would greatly appreciate if you smash that like button down below. It really helps me grow the channel and be shown and to be exposed to more viewers just like you. My name is Jay Costa. I'm a real estate agent and investor here in Northern New Jersey. On this channel, we talk about investing of all types: real estate investing, stock market investing, personal finance, general entrepreneurship, you name it. So if you have any interest in these topics at all, please consider subscribing down below. Would truly appreciate it. Now on to the video. Okay, so first let's go over exactly what a home equity line of credit is. A home equity line of credit, or a HELOC for short, is basically a revolving credit line based on the equity that you have in your primary residence. It basically allows you to use the equity that you've built up in your home as a credit card and allows you to pay it off and take money out as you please. For a more in-depth understanding of what a HELOC is, as well as how to apply for one, check out my video in the description box down below. I'll also link it up here in this corner, so go check that out. HELOCs can be a great tool in investing, both real estate investing or just any investing opportunity at all where you need some access to capital short term. But another potential use for a home equity line of credit is to use it to pay down and pay off your mortgage early. This is a method that's called velocity banking. My intent with this video is not to give you an exact tutorial on how to use velocity banking to pay off your mortgage quickly. It's more just to give you an overview and an understanding of what this method is, what the pros and cons are, as well as the risks involved that you need to be aware of. So velocity banking is a method that uses the equity of your home through a HELOC, a home equity line of credit, and uses it to pay down and completely pay off your 30-year mortgage in anywhere from 7 to 10 years. I know, it sounded too good to be true to me as well, so I dug further. Here's how it works. Let's say you have a house worth $500,000 and you still owe on the property on your mortgage $350,000. That leaves you with $150,000 worth of equity. So then you go apply for a home equity line of credit and they end up giving you, let's say, about $100,000 in a home equity line of credit. Using the velocity banking strategy, you take that $100,000 from your HELOC and just use that $100,000 to make a lump sum payment of $100,000 into your 30-year mortgage. So now you owe only $250,000 worth on your mortgage, but you have a $100,000 balance on this home equity line of credit, which is generally at a higher rate than your conventional mortgage. You then take your full paycheck and direct deposit it right into your HELOC account to start paying down that $100,000 balance. In addition, you also use that home equity line of credit for any additional living expenses like groceries or bills or things like that. So basically, you start using that HELOC account as your general checking account for living expenses, at the same time as paying it down as quickly and aggressively as possible. So if you're anything like me, your first question after hearing all of this is, why would I take $100,000 out of a mortgage that is at a lower fixed rate and put it into a HELOC, which is a higher variable rate? The benefit that velocity banking provides to you is in the details. It's not about the interest rate per se, it's how the interest is calculated in each of these two programs, these two accounts. You see, a 30-year loan is on an amortization schedule. It's on a 30-year amortization schedule. That means your payment never changes. It's a closed-ended loan, and as you start making payments on your mortgage, early on, most of that payment goes towards interest and less of it goes towards principal. And as you continue to make those payments over and over every month, a little bit less and less and less goes to interest, and more goes towards paying down your principal, all while keeping your monthly payment the exact same. It will never change. In comparison, on a HELOC account, the interest is calculated using what's called an average daily balance. So they'll take the balance that you have each day, they'll average those numbers out over a month, and that's the number that they base the interest payment off of. So basically, by taking your paycheck and depositing it right into your HELOC account at the beginning of every single month, and then paying off all of your monthly expenses towards towards the end of every single month, you are reducing the balance on that chunk of mortgage debt that's now sitting in your HELOC. And by paying it down to closer and closer to zero over time, it reduces that average daily balance sitting in that HELOC account to about half of what it would be sitting in the mortgage. There are calculators out there showing the potential savings that you'd have if you use velocity banking with a HELOC in order to pay down your mortgage. I'll put a link to one in the description down below. Believe it or not, put the numbers in, it does work. It saves you a lot of interest over time and it pays down that mortgage very quickly. I use some general numbers based on my own home and my own situation in this calculator, and based on using just $100,000 of my home equity line of credit, I'd be able to completely pay off my mortgage on my house in just over 11 years and save up to $138,000 in interest that I would pay to the bank. If you are a diligent saver and make substantially more than you spend, you also may want to look into this option because this method is really like tailor fit just for you. So on the surface, this sounds like an excellent option. So why wouldn't you do it? Well, here's the reasons that I came up with, and unfortunately, they outnumber the reasons that I should. First, to make this work, it really hinges completely on the fact that you're getting a low enough interest rate on your line of credit when compared to your primary mortgage rate. I would say, general rule of thumb, the interest rate on your HELOC should not be any more than double max of what your current mortgage rate is. If you can't get a low enough rate on the HELOC, you could end up actually paying more than if you simply just paid a little bit extra towards your mortgage every single month. This method is simply a compounding hack, which benefit and effectiveness completely dwindles if the delta between your HELOC rate and your mortgage rate gets bigger and bigger. Second, the home equity line of credit interest rate is a variable rate. It changes. It's not locked in like a standard mortgage rate. So in the future, that number, we don't know what that number is going to be. It could very well be much higher than it is today, and that can completely screw up your plans. When comparing this to a fixed rate on a standard mortgage, this adds a substantial amount of risk in my view. Third, this strategy is heavily reliant on paying down that HELOC balance that you have as quickly and aggressively as possible. So if you don't make substantially more than what you spend every month, I would really advise against using this strategy, because that means that your balance is either going to be staying the same or not going down quick enough, and that average daily balance interest rate on the variable rate in the HELOC will completely financially ruin you. Fourth, the interest that you pay on a HELOC is not tax deductible. One of the biggest advantages of owning real estate is the tax deductible interest that you pay on your mortgage. So if you pay, let's say, $3,000 a year of interest on your mortgage, you can deduct that off of your taxes. You cannot do this with a HELOC, and you're foregoing any tax deduction that you would be getting on your mortgage payment. So even if this doesn't completely make up for the interest that you'd be saving by paying off your mortgage early, it does shrink the gap a bit. Lastly, and this is the biggest drawback to the velocity banking strategy, at least for someone in my situation, this strategy is heavily dependent on taking all of your income, all of your paycheck, and putting it right into the HELOC to pay it off as quick as possible. So what does this do? Well, this means that this takes away the opportunity to take any extra income that you have and invest it. This is a huge drawback for me as a real estate investor as well as a stock market investor. Now, you could say that since you're paying off your mortgage much faster, let's say in like 10 or 11 years instead of 30, after those 10 or 11 years, you'd be able to be mortgage free and you'd be able to invest that money. You'd be able to invest 100% of your paycheck. But to me, there is an opportunity cost in those 10 or so years. What happens in those 10 years? What could you put your money, instead of putting it into a HELOC to pay off your mortgage, you could put it into real estate, appreciating assets, stock market, S&P 500 index funds, anything like that. To me, there's an opportunity cost loss here that I may not be able to recoup after those 10 years. So after doing all the research, I can come to the conclusion that velocity banking is not BS. It is a legitimate way, a legitimate strategy to compound over time the principal pay down of your mortgage and leave you mortgage free much sooner than the average 30 years. But there are drawbacks, and given these drawbacks, for someone in my situation, I have decided to not use the velocity banking strategy. I am an investor first and foremost, and I'd rather use the excess income that I have to invest it into appreciating assets like real estate or broad index funds that will appreciate substantially over time. I'd rather use leverage and kick the can down the road on any interest owed in the future on my mortgage and use that capital now to invest and build wealth. Because my plan long term is to grow those investments to a point where I could just write a check and pay off my mortgage anyway without using any velocity banking. But everyone's situation's different, so your mileage may vary. That is it for today, guys. Thank you again so much for watching. Let me know what you think about this strategy in the comment section down below. If you have any experience with it, let us know your thoughts, positive or negative, or if you thought about it and decided one way or the other, let me know in the comment section down below. Would love to learn more about what you guys think about this velocity banking strategy and paying off your mortgage quicker and easier. Hope you enjoyed the video. If you liked it, give a thumbs up and consider subscribing, and I will see you next video.